Hello, dear Etorians. This is PC here from Global Alpha Search. It's Saturday morning. Today, July 31st. We just finished another month. So I thought it's a good time to make a little summary of what was up this month in our portfolio, how we performed, and what are the plans going forward. I'd like to start with the fact that we had another positive month. Let me just quickly present to you screen. Yeah, so we had another positive month, ended, just a second. Yeah, we ended up 2.3% in July. So given the fact that, the markets have been wobbly and many equity exposed investors have been struggling. I know some of the popular investors, mostly equity exposed, were having troubles maintaining their portfolios in the green, being down between 5 to 10%. We managed again to be up nicely. And as you see here, it's pretty much the fifth month in a row when we are either flat or up. In May, we were down 20 basis points, so it's pretty much flat on month, right? We started out the year a bit down here. The two starting months were down, but this was mostly due to the fact that that was the time when we're doing quite a bit of refurbishment in the portfolio, preparing it for the recovery and expansion periods. Now we're well positioned. Equity exposure is adjusted to the economic cycle phase, and we're still exposed to possibly the best blue chip stocks that you can ever own. So they're on one hand very safe. They have a lot of cash on their balance sheets. Their tendency for them to correct is relatively small compared to some other more indebted companies or smaller companies. And it was very nicely seen during July when, there were times that the market felt very sold off. You could have seen it by the fear and greed factor, for instance, which was down at like 17 points only at some moment. And many names were down substantially. Our setup of blue chip names was doing just fine during that period. As you see here, this is the portfolio right now. So we have roughly 22, 25 names right now in the portfolio. Most of them are blue chip growth stocks. We started adding up some mid-cap names and some value names as well, but I will come back to that in a moment. But what I wanted to start out with is that our portfolio is very well positioned for this period of the economic cycle phase, and this is exactly why we perform as we perform, right? So we are achieving our goal of maintaining stable growth, stable positive returns with very limited downside volatility. And this is basically our major target of the Global Leaders portfolio, to find this appropriate balance between risk and reward, right? So sometimes, given the fact that we're also all the time exposed to other assets like the US Treasuries and gold. So sometimes we will perform not as good as the equity indices, but please remember, we are not a pure equity fund. We are a macro adjusted cycle phase following fund. So our allocation in the most risky assets, which are equities, will swing from pretty much down to zero to up to 70-75% as the portfolio looks right now. So yeah, this is it to start. Why are we up this month? Pretty much for a couple of simple reasons, right? So as I have already mentioned, our portfolio is basically built up of very well diversified bunch of stocks and other assets. The stocks that we're choosing are stocks that are very safe, very good-looking balance sheet and free cash flow side stocks. Mostly blue chips, right? All of them are fulfilling CS score, so our proprietary scoring system. So this all means that this makes them resilient to the downside pressure in cases when things go bad, especially with the environment that we're having right now with relatively low yields and very okay economic growth, right? As I have mentioned already many times in some of my posts, when yields go up, our bunch of stocks performs a bit worse because they're mostly growth stocks, right? So higher yields usually mean higher discounting rates for growth stocks. And this is pretty much what we saw in January and February this week. But our basic scenario for the yields is basically to be flat to down. We are not expecting inflation to be stubbornly staying at the levels that we're seeing right now. The Fed is bringing the message of inflation being transitory, and I do tend to agree with that. Going forward, I would rather see the US 10-year yields to stay at current levels, which is 130, 140 basis points, or lower going forward. What we did this month as well was swinging a little bit between the allocations geographically. We have lately, like pretty much this week, added a nice exposure to China. There was a massive sell-off in the Chinese stocks caused by the crackdown, the regulatory crackdown on the biggest Chinese tech companies. I think what it will all end up with is basically the stocks that are mostly listed in US right now, the Chinese stocks, to become dual listed in Hong Kong or Shanghai as well. And I don't think the pressure from the watchdog will be so destructive for those names to keep selling off for much longer. Many of those names are selling at an absolute bargain. I have written some posts on this this week as well, so I invite you to have a read through them as well. But all in all, we added exposure to the two major stocks from China, which is Alibaba. We have increased our weighting here quite substantially. It's roughly 8% of the portfolio right now, and I have also added some Baidu, which is also trading at some extremely sold off levels, both technically and fundamentally. And we are getting some more exposure on China in general through the CQQQ ETF delivered by Invesco. So all in all, China is now roughly 19% of the portfolio right now. It's a tactical play. We're planning to catch a 30% rebound here going forward in the upcoming months. And this was mostly done at the expense of selling some of the US blue chips like Microsoft, Apple, and some others which have been reporting, but the expectations for this quarter reports were just as high as pretty much not for a very long time in the history. Obviously, last year was a very bad year, right? So the dynamics, the year-on-year dynamics right now are extremely positive. And even though most of those blue chips managed to beat the expectations, there's been a tendency of profit selling after the numbers. So what Wall Street calls is sell defects tendency. And we took a chance on this, and we decreased some exposure in those names just ahead of the numbers, which turned out to be a proper move. because most of those names are trading down right now. We will obviously be looking for good entry points again into those blue chips names, because they are our core long-term plays, right? So we will definitely be coming back with exposure to Microsoft, Apple, or Skyworks, and some others that we have decreased allocation to during July. What we did as well is added a little bit of financials, as I promised. We added Citigroup and Interactive Brokers to the portfolio. We will keep increasing that to kind of more and more balance the portfolio with some cyclical plays, which are appropriate for the recovery phase of the economic cycle. We've also added some mid-cap names like Clorox, Discovery, or Micron Technologies. And we have also added some of the blue chip value names like Royal Dutch, for instance. The aim of this is basically to kind of keep improving the ratio between risk and reward in the portfolio as a whole. So we're not only diversifying between the growth stocks, but we also adding more value to the portfolio, which eventually will mean that the diversification effects will just keep growing and growing. Going forward, stable risk score since February at 4, and that's the plan to keep going forward as well. So as you see, with a portfolio of mine, you're getting positive returns with quite a bit of stability and very constrained risk characteristics, right? We're still using the opportunity from time to time to go long the trade of being short volatility and long equity. We did it once in July, earned a couple of percent on that. And as far as we've got the Fed put behind us as investors, I think the long equity short volatility trade is the one to trade, and it's kind of a no-brainer to me. Going forward, we will worry about unwinding this trade when the Fed starts winding down their balance sheet, basically. But we've had the Fed meeting this Wednesday, and the message is basically we're keeping our policy as it is. So no change here. Asset purchases will continue at 120 billion per month pace. And so far, Mr. Powell has given us no clue as to when they would start the tapering. So as long as that does not happen, I'm not expecting any bigger corrections in the market. And we will keep trading short volatility, long equity trade going forward as well. So guys, this is it from me today. It was a good month, and we're well positioned. I will keep you up regularly. If you would wish to follow or copy me, please don't hesitate. Also ping me a message whenever you want. I'm here for you to help and kind of clear any questions that you would have. Thank you very much for today, and have a good weekend. Bye.